Hello and welcome to today's daily educational video. I'm your host Robert Blackwell here at Forex.Academy, and during this particular video we'll be discussing the spread, really the bid and ask spread. We define it as the cost or the transactional cost to trading as a retail trader. So before we do begin, please do familiarize yourself with the quick disclaimer. There is of course risk inherent when trading in the financial markets. On today's webinar content, of course, with our education, we'll be defining the bid and ask spread, and we'll take a quick look just both on the institutional side as well to what that actually means as a difference to retail trading. So let us first of all define the spread. Well, the spread there is the difference between the bid, which is the price that you can buy a market at, and of course the ask, which is the price that you can sell a market at. So there is a small premium there. To name but an example, if we decide we would like to trade the price of oil and the current price of oil is at 61.50, we won't actually be able to purchase that market at market price. As well, we won't actually be able to sell that market at the same price, 61.50. So there is a little premium involved. To say that the spread is simply 6 pips, that is the difference between the bid and ask. So in this particular example, we will be able then to buy or go long the price of oil at 61.53, and of course alternatively to sell the price of oil at 61.47. So there is a certain premium to this. A best bid is the best or lowest price a trader can buy the market at any given time. And of course we call the spread the ask the best offer. It's really the best price sellers are looking to offer the market down to buyers or potential buyers. Best offer is the price sellers offer the market for an asset at any particular time. There is always a cost to trading the financial markets. The spread asks the trader to effectively pay a small premium between bid and ask as a transaction cost to each particular trade. So it's simply the transactional cost multiplied by your volume or trade size for each particular market. The spread cost is actioned both when a trader enters and exits the trade. And that's very important to understand. Trading the MT4 platform with your CFD trading platform there, perhaps you actually pay this small premium as a cost when you enter the trade, and then when you look to exit that trade, whether you're exiting for a profitable position or not, you will still have to pay the premium when exiting the trade as well. The spread cost does vary per market and asset classes. Traders should be aware of what they are trading and the costs associated. So there are particular asset classes or markets where they're quite cheap to trade, and that will reflect itself in a very short or tight spread. And perhaps the best example of an asset class is the Forex markets. The currency markets are notoriously very cheap to trade. That is reflected with a very tight bid and ask spread. As an alternative, something like an exotic product, perhaps a metal like palladium, it's not as popular to trade. There's not as much liquidity in that market, and that will be reflected in a much longer or wider spread. And obviously, as a transactional cost, it will be slightly more expensive to trade. Illiquidity will cause the spread then to widen, while highly liquid markets will generally have much more volume and hence tighter spreads. So what I would like to do is just to discuss here the spread in terms of the bid and ask, both at our institutional trading or proprietary level and retail trading platforms. So in terms of these two platforms, we have what's known as Xtrader here, the S&P 500 market, and then we have our Market Watch for the currency markets there on our MT4 trading platform. So what I'd like to do is simply annotate what the bid and ask is for each of these particular trading platforms here. Here we have up on the left-hand side the buyers, and they're really placing orders here between these 2 points at each different price. This is the price here. What I'll do is just put P below the price, and as the market either trades up or down, it trades through the prices. Here is the collection of sellers looking to offer the market down. So basically what this means here at this price here, 1260.60 there, 759 traders or sellers are actually offering this price to sell the market right here to potential buyers who want to execute at market price. Alternatively, within this price here, we have 124 buy orders looking to effectively buy the market at this price here. So there is no direct bid and ask spread really. It is in this sense one pip where it can either place an order to get filled at market or to actually buy one price above or sell one price below at market price. The market here agrees a price where buyers and sellers meet, and this price moves as the market itself moves. Okay, so that's our institutional trading ladder, and you can see how there is, I suppose, a little more advantage to actually trading more relative price action when actually looking to trade the order book there. Not available to us because we need a lot of capital, really a lot of capital to trade, particularly in the futures markets. What is available to us is leverage as retail traders to access large amounts of capital, and so we move towards our MT4 trading platform. Here we have both the bid and ask spread. So that is simply the price that we look to buy the market or alternatively sell the market at. And you can see with each particular currency pair here notated on the left hand side, and we have some commodities to the lower end of the market as well as equity indexes here and here. We can see that we have a variance of different prices here. So just to annotate but a few, we have 88 5112 and 88 537. So we can't denote the last figure is simply an increment. So it's really 53 to 51, which is a 2 pip or 2.5 pip spread on our euro pound. So the CFD broker here quotes the bid and ask prices in line with underlying markets. The prices move as the markets trade, and effectively we do pay a little premium when we decide to either buy the market or sell the market. So that gives a little insight just into actually how prices are quoted, first of all, and how we can look to speculate both as buyers and sellers. And really, in terms of an overall effect on our trading, if we're attempting to profit over the long term in trading these markets, it shouldn't really factor too much into overall progress or profit as a profitable trader. It's simply cost of doing business and something we do have to factor in over the long term in our trading. So that brings us to the end of this short educational 10-minute video. I do thank you for joining us. From all of us here at Forex Academy, thank you so much, and I'll see you soon. Bye for now.